Can you keep up with the pace of market regulatory reform? MarketsReformWiki.com, the place to keep up.
Can you tell us a little bit about OneChicago?
OneChicago came into existence with the Commodities Exchange Act reauthorization legislation, which is from the Shad-Johnson Accord, which lifted the ban in 2000. From that time to November of 2002, when the exchange actually launched the product single stock futures, which in the legislation basically allows for the CFTC and the SEC to share joint regulation of the product. So for those licensed FCMs and future exchanges, they just have to notice or register with the SEC to be able to trade the product. Those that are licensed on the security side, BDs, have to notice register with the CFTC. So the product has the ability to trade and clear in a securities account or a futures account, therefore giving it exposure and access to both sides of the trading community.
Why are you pitching this to the CTA and Managed Futures community?
That community has managed futures accounts where you have individuals that they're obviously providing opportunity in commodities, and now what they're doing is trying to mirror strategies that are similar in their momentum trading, their trend trading strategies, diversifying a commodities portfolio for them by over or underweighting that portfolio, and the security futures allow them that opportunity in the equity world. Whereas they can't trade equity products more likely than not because of the way their mandates are. Security futures allow them to do this because it is a future, which is the beautiful part of it. They put it in the future side and they distribute it to their managed futures accounts just like they do their commodities trades.
What are the 1C and 1D contracts?
1C is simply the price of the stock, a forward carry of that price of the stock to the expiry, which we have 2 serials. Right now we have Fridays for February. Third Friday of each month is an expiry. So we have February, we have March, we have June and Sep as our 4 contract months. There's always 2 serial and 2 quarterlies, which mirror the broad-based indexes. The 1C product, as I described, is just the product, the price of the stock, plus that forward interest of an implied rate being passed through into the pricing by a market maker or a bank that's making a market, minus any expected dividends. In October of 2010, we created the 1D product. It's a no dividend contract where it basically is the price of the stock plus any forward implied interest carry added to that. And on the X date of any given X dividend date of a stock, the OCC, the Options Clearinghouse, adjusts downward that exact amount of that dividend value in the settlement price, therefore moving the basis price of that position down by that amount. What in effect that accomplishes, it eliminates the risk of what that X dividend date may be, which is a lot of times for some equity names a problem because it might be in an expiry or out of an expiry, which changes pricing of options and therefore their hedge, which could be stock or the future. And the same thing is like in a lot of the ETFs, the SPYs, the EEM, the IWMs. A lot of times those dividend amounts, they're not exactly known until the morning of the X date. So it's very hard to manage the risk associated with pricing of those instruments, not having a finite defined value for those dividends. This allows that to be mitigated by trading the 1D contract.
Does taking out the dividend risk in the 1D contract make it attractive to the CTA Managed Futures community?
All it is an equity product with an interest rate attached to it, which makes it very simple for their pricing. They don't need all the technology and all the research to be able to track dividends to have the extra knowledge to create the pricing model they would need. The new bets platform at the exchange, where all these liquidity providers are, banks, market making groups, introducing brokers that find more liquidity, this is where the blocks for that product trade to give them liquidity, which is the key word here, liquidity, which is always a question asked to me at OneChicago on the business development side. Is there liquidity at the exchange? Absolutely.
If there's high liquidity, why does the bid-ask look substantially wider than in the index futures or stock market?
When you're talking about the bid-ask spread of single stock future, you got to keep in mind that it's for a term. It's a price, the future's price for the term of each expiry. So think of that interest carry added to the price of the stock, which is going to change the price and make it a little wider because of that time factor. And then you have your groups that are making markets. They're looking to obviously create an arbitrage of either trading the other derivative of which is options or stock against the single stock future. So there may be a little bit wider than the price of the stock. But what makes it a very efficient product is the exchange of future for physical product, which is where stock and future are traded simultaneously. And those trades really show you that it's an interest rate product because the basis, the difference of the future to the stock, is in sub-pennies and sub-tenths of pennies, which is mirroring and transcending what the real interest rate market structure is, what we all know today, is near zero. So to be able to afford the single stock future through that transaction gives you a real understanding of what the liquidity is in the marketplace because of that pricing functionality of the EFP.
So you're saying that a CTA can actually get access to a market that is much tighter than what is shown on the central limit order book?
Absolutely. There's no comparison between a market, what we call the CLOB, Central Limit Order Book of the Exchange, and the EFP environment or block environment. Because the block and EFP environment is where the big groups are offering their interest rate in this size that's available in blocks, which is where these CTAs trade the no dividend product because of the ease and the efficiency of the not having to deal with dividends, and then the benefit of this interest rate exposure in size. And then they roll the positions. That's the beauty of it. Once they create a position, if they want to continue the position because the momentum of the market is going in that direction, they adjust the position, or when expiry comes, they roll. This week is February expiration. I would imagine that if you look at the volume of the exchange, you'll see a lot of rolls taking place on Wednesday and Thursday of February positions to March for these type of CTA traders.
What do you think is coming in the single stock futures space?
Well, I think with all the changes and the dodd-frank reform that's coming down the path in the next 6 to 12 months, what's happening is the fact that we're on exchange. We're regulated by both the CFTC and the SEC. We're cleared by the Options Clearing Corporation. Our platforms are anonymous and transparent. We are meeting what I think are all the requirements and the desires and designs of government to regulate all products going forward. So we're there already. When these OTC products go on exchange, there's going to be inherent costs there. Well, we've already got those costs and we're already very competitive without having those products go to on exchange where they're going to pick up all these overhead fees that they don't have today.